Thank you very much. It's great to be here, and I would like to add my thanks to Tyler and to Numerica. And I would like to thank you, Cheryl, for your leadership and help over these many years on so many projects I've been involved in. And Reva, it's great to have you here and have your leadership in the program this evening. So let's plunge in. One of the things that has been said by the most important financial personalities of the day is that financial crises cannot be predicted. That the crises of 07, 08 could not be predicted. And if we have one in the future, it cannot be predicted. We've had some folks refer to these events as black swan type events, once a generation type events. We believe that financial crises can readily be predicted. And furthermore, since we have the information to predict them, we can prevent them. And we can do that by focusing on private debt rather than a focus on public debt. And I start by giving you a sense of how big a factor private debt is in the economy versus government debt and other things. If you look at this chart, what it is the growth in these categories between 1997 and 2007, which was the decade leading to the crisis itself. And as you can see, private debt grew $14.4 trillion in that 10-year period. That absolutely dwarfs the growth in government debt, which grew about $3.5 trillion. It dwarfs the $3 trillion growth in the money supply, which economists kind of endlessly point to. Frankly, it dwarfs the $5.5 trillion growth in GDP itself. Private debt is the biggest factor in the economy. And look over here at some of these other things. Federal taxes increased annually or over this 10-year period by $1.5 trillion or so. Exports are about $1.5 trillion, so the increase over the 10-year period is about $0.5 trillion. So in this 10-year period, if we had raised taxes or lowered taxes by 10%, that would have impacted the economy by about $2 trillion. Lending created $14.4 trillion in this period. It's the 800-pound gorilla, if you will. Now, I hope I can get, there you go. Private debt was the cause of the 07-08 crisis. Now, the biggest part of this was mortgage debt itself. Here we show mortgage debt as a percent of GDP to normalize it through time. And from 1970 to 2000, mortgage debt grew about 17% per annum, per decade. In the 6 years between 2001 and 2007, it grew an astronomical 46%. That's what precipitated the crisis. And it wasn't just mortgage debt, it was all forms of private debt. If you look here at the growth levels between 01 and 07, private debt in aggregate, and by private debt I mean consumer debt plus business debt, those two together grew 20% to GDP. And frankly, as you can see, even though these levels have delevered a little bit, by historical standards, private debt is still near an all-time high in the United States, both on the consumer side and the business side. We ask the question, if private debt caused the 07-08 crisis, was it a factor in other major crises in our lifetime? We looked at the Depression, and sure enough, you see this telltale pattern of a rapid increase in private debt in the 5 years leading up to the 1929 stock market crashes. One historian reports that in 1927 alone, there were 1,000 or more skyscrapers under construction across the United States. There was a skyscraper being built in Beaumont, Texas that was larger than any skyscraper on the continent of Europe. We looked at the Japan crisis right here, which happened where this black dot is in 1991. It was one of the major crises of the post-World War II period. And again, we see this very telltale pattern of very rapid growth in the 5-year period leading up to the crisis. In this case, 28%. Now you'll notice something else in all of these crises. Government debt in the period prior to the crisis, which is right here, is low and very benign. It's not increasing. In Japan, you have the same thing. In the 5 to 8 years before the crisis, government debt is low and stable. Government debt is not a factor in the period leading up to these crises. Then we go look at the Asian crisis of '97, really the other major crisis in the post-World War II period. And the two biggest crises within what is referred to as the Asian crisis were Korea, South Korea, and Indonesia. Here we see the telltale pattern again. Rapid ascent of private debt in the 5 years prior to the crisis, 29% in Korea, 43% in Indonesia. And in both cases, government debt is low and benign in that period. Here's an even more extreme case. Spain, which of the major Eurozone economies has had and continues to have the most egregious situation. In the 5 years leading up to their '08 crisis, private debt to GDP grew by an astonishing 49%. Public debt actually improved in that period. When you're having a lending boom, everybody feels like they're getting rich. They're paying more taxes. The government revenues are flowing in. The government feels like it's a miracle. That's the hallmark of the period leading up to our crisis. Now, we went beyond these 4 crises and we looked comprehensively at every crisis in major economies in the world. And we picked a cutoff of $500 billion or more. And there's 22 countries that have $500 billion or more of GDP. And they collectively constitute 85% of world GDP. So if you look at those 22 countries, frankly, you're really looking at the world. Small countries can have crises for a lot of reasons. They can be next door to a country that's having a crisis, and that alone can cause them to have a crisis. But for major economies, these 22, any time you have private debt to GDP growth of 18% or more in 5 years, and an overall level of private debt of 150% or more, you get a crisis. It happens almost without exception.
You're going to tell us why?
I will. That's an excellent question. Let me say one more thing before I get to that. It's not just mortgage debt. In the U.S., it was mortgage debt centric. So a lot of commentators are saying, you know, this is a mortgage debt phenomenon, and if we can prevent runaway mortgages in the future, we can prevent crisis. But other crises have been more business debt than consumer debt. In Japan in '91, it was more commercial real estate and industrial lending. That was also true in Korea in '97. So the key is tracking aggregate private debt, both consumer and business together, not just consumer. So why does runaway private lending, and when it grows this 18% in 5 years, I use the term runaway lending to describe it. Why does it cause a crisis? 2 reasons. First of all, you've built too much of something. You've built way more of something than you need. In the case of the '07 crisis, it was way too many houses had been built, far in excess of the actual demand of consumers. In Japan in '91 and Korea in '97, it was way too many commercial office buildings. It was way too many industrial plants. You know, if you go back, we'll look at in the book we actually look at this phenomenon in the 1800s and the huge crisis, post-Civil War crisis in America. It was in 1873 and 1893. It was way too many railroads. So when you do that, you have made a lot of loans to finance those things that are going to be bad loans. Since you've built things that no one's going to use, there's no income to repay those loans, and that creates the crisis. To give you a sense of it, in the United States, over this 5-year period, we created about $2.5 trillion in bad loans. The U.S. banking system only has about $1.5 trillion in capital. That alone should have alerted us that there was a problem. That's the magnitude. Once this has happened, monetary and fiscal policy, which is what the United States government and European governments and the Japanese government have relied on almost exclusively, monetary and fiscal policy can't really solve the problem. They can ease the pain a little bit. There's only two things that can solve the problem. One of them is capital to recapitalize the banks that have come close to failure, and the other one is time. Because if you have way too many houses or way too many office buildings, it's going to take time to absorb that. And you can't really shrink the time it takes to catch up to that excess capacity. Now, triggering events are often mistaken for the cause of the crisis. So a stock market crash itself is often thought of as the cause of the crisis. A bank failure is thought of as the cause of the crisis. Those aren't the cause of the crisis. The cow is already out of the barn by the time those things happen. There has already been this 5-year buildup. You already have too much of something and too many bad loans. It's just a symptom that the problem is out of control. Now, there are a lot of other explanations for these crises. You know, I continue to read them. You know, there's not a week that goes by that somebody doesn't comment on some crisis somewhere and attribute to something. A lot of people have blamed it on government debt, but we've clearly seen that that's not only not an indicator, it's probably even a contraindicator. We've had people talk about things like current account deficits, trade issues, currency issues. We looked at 20 different factors in all these 22 countries over all the years for which we have data, and none of the others are good predictors or indicators of a crisis. Only one thing is, and for the common sense reasons we've suggested, runaway increases in private lending. Now, let's step aside for a moment. Apart from its role in generating crisis, high levels of private debt are a problem in and of themselves. Here is a startling statistic that when I first came across it, I had to spend a couple of months rechecking the data because it seemed so out of whack. But in 1950, private debt to GDP in the United States was 55%. Today, it's 156%. Private debt has tripled in the United States in a little over 2 generations. And what happens is, when you have so many people that have this high a burden in debt, they have to take their income and spend a disproportionate part on paying down that debt. And that's money they otherwise could spend on vacations and restaurants and home improvement and all the other things that power GDP. So the fact that we have this much private debt itself is a suppressant on GDP growth. It's the issue. And this has been supported by a number of studies, including fairly recent studies by the BIS and the IMF. Debt growth, debt once accumulated, acts as a suppressant to growth. And it's not just in the United States. Here we've taken kind of what I would call the big six in the world, the UK, Italy, Germany, China, France, etc. And you can see that this group in 1970 was all clustered around about 75% private debt to GDP, and now they're closer in aggregate to 175% to to GDP. So it is a global phenomenon. So how do we prevent and how do we repair? To prevent, we monitor the aggregates. If you're convinced of this theory, it becomes pretty easy to see it many years in advance. And I was in the banking industry for a long time, and I know regulators have a broad array, or arsenal, I might say, of ways to influence the behavior of banks. They can influence your credit policy, they can increase your capital requirements, they can jawbone. There's any number of things. And recall that the behaviors in 05, 06, 07 were not ordinary behaviors. People were making loans to folks that had no income and no jobs. I mean, a regulator can intervene to influence that kind of behavior. So we think by monitoring the aggregates, regulators could see and prevent crisis. But that leaves the more important issue of where we are today, the issue of repairing the crisis. Because what we've seen is we've accumulated a lot of private debt, and that's dragging down economic growth today. So the way to unlock stronger economic growth in the United States is to reduce our ratio of private debt to GDP. Well, that's a lot easier said than done. How can you do that? Well, you could have people pay down debt, but paying down debt takes money out of the economy and actually contracts GDP. That's exactly what happened from 1930 to 1933. It has a contractive effect, so it's self-defeating. People often talk about growing your way out of the problem, but here's the interesting thing about 200 years of economic history, and that is, with tiny exceptions, private debt growth always exceeds GDP growth in modern economies. So there's no reason to think that we could grow without private debt continuing to grow at a faster rate than economic growth. We can inflate our way out of this, and there's technical reasons I don't think that's possible, but even if it was possible, take any assumptions you want to make, and it takes 20, 30, 40 years to get the ratio back into a level that would be appropriate. So inflation doesn't get you there. By process of elimination, that only leaves one thing, and that's restructuring debt. Going in and tearing up lending contracts with borrowers that are problematic loans and leaving them with lower debt levels. For example, there are 9 million mortgages in the United States that are still underwater out of the 52 million mortgages in total. These are folks that are current on their payments but are struggling to make those payments, and as a result aren't spending money on vacations and cars and clothes and restaurants and the things that would power GDP. Now, anytime you bring this idea up, it's like a lightning rod. There's a lot of objections to it based on the concept of moral hazard. If you let somebody off the hook, they'll go sin again. Well, we suspended our concerns about moral hazards when we saved the banks. We just didn't suspend our concerns about moral hazards for the borrowers. And maybe we shouldn't do it, and maybe it's politically infeasible, but I promise you, it is the thing that if you did it, would supercharge economic growth. The other thing that's interesting about this is it's these high levels of debt, particularly in Japan and Europe, that actually serve to put pressure in a deflationary direction. There are endless articles you could read about, Japan's deflation. And it's ever since their 91 crisis they've had. So 23 or 24 years of concern about deflation. Well, Japan's private debt to GDP reached 220% in 1991, and it's still at 170%. It's come down in this painfully slow fashion that itself has been the deflationary agent. If you want to get rid of deflation in Japan, restructure debt. Loans can grow again. Deflation won't be an issue. You're starting to read those headlines in Europe. There's starting to be headlines as recently as the last day or two about oh my God, we're facing deflation in Europe. In the United States, private debt to GDP is 156%. In Spain, it's 216%. In Portugal, where we just had a bank failure, it's 255% to GDP. You want to reverse things in Europe? This is where you go. Okay, we just got a couple more slides here. So with all that behind us, where are we concerned today? And our concern is in China, where after you can see relatively flat private debt to GDP levels through the mid-2000s, private debt to GDP has been on a tear since then. We talked about 18% being our threshold of concern. China is at almost 60% private debt to GDP growth. That has been the source of their boom. But we also read about overcapacity in China. You know, you've probably all read about ghost cities in China. So much real estate has been built beyond the need of the country that there's entire cities that are effectively empty, with thousands and tens and thousands of empty residences. And by the way, their absolute level of private debt is now, we show it here at 180, but we just got a new number and it looks like it's over 200%. So runaway lending, again, has yielded overcapacity. Unused real estate, land, empty shopping malls, excess manufacturing. So what's the future of China? We think a crisis is possible in the next few years, but China has something that's true about it that was not true in the United States and Europe. China owns the banks. So it's unlikely in our minds that China allows for that type of crisis. In addition, China has low central government debt, and it has ample net worth. Ample, you know, there's probably $3 trillion of foreign currency reserves on the books of it, the PBOC. So it has the capacity to deal preemptively with its problem. But even if it does, China has a significant and increasing level of overcapacity. Here's a very interesting thing. People rejoiced recently when China reaffirmed that their GDP growth level was 7.5%. Everybody's been concerned, and everybody gave a sigh of relief. But GDP growth is more a measure of the capacity being created than it is a measure of the capacity that's needed. So if China continues to grow at a high number, it's simply compounding its overcapacity problem, and things could unravel. We think the probable case, and it's not going to be tomorrow, but in the next 5 years, in fact, we're actually doing a new project on this over the next several months to try to come up with a prediction of how this will happen. But we think China has to see significantly decelerated growth. Japan may be a foreshadowing of that. Since its 91 crisis, in the 23 years since its 91 crisis, it has grown at near 0% per annum in real terms. It's what we would call sideways growth. So we think at some time in the next few years, China itself is going to be facing a generation of what we would call sideways growth. We think China needs to act preemptively to recapitalize its banks, and we think it needs to slow down GDP and stop building capacity that it and the world don't need. That's our remedy. Anyway, thanks. And Ray, thanks. Thank you.
The mic's okay? Okay. So, Richard, for someone who's been following markets, obsessed with public debt, could be surprising. Let's start with the math. How were you able to confirm that that's a causal relationship that you've identified, that it's because of the private debt that those correlations exist?
Well, we looked at the 22 instances where it has occurred, where we have data for these large countries. And in 20 of the 22, it led to a crisis. And there are no crises that have occurred where it was not true. And the two instances where there was that level of growth and hasn't been a crisis are Australia and South Korea, which are adjacent to China and in our view have been buoyed by the growth in China. So we think they are still kind of in the crosshairs and will probably have a crisis of their own.
So government wants consumers to spend, tax policies incentivize consumers to spend, markets are focused on public debt. The argument is kind of against the momentum. So is everyone wrong?
Well, I think the two major schools of thought are that we need to stimulate the economy, we need to ease, that kind of prescription. And the other, the hawks, so to speak, think we ought to rein in spending and be austere. And let's take both of those. If we stimulate through government spending and ease, we're still going to have too much private debt. It simply doesn't address the biggest factor there. The hawks, frankly, on the eve of the crisis in 2007, the hawks were concerned about inflation. And they're still concerned about inflation. Neither side's theory has had any predictive value. Neither side's theory addresses the single biggest factor in the market. So I hate to be blunt, but yeah, they're both wrong. And by the way, I don't think the issues they're dealing with are incorrect. I think the issues they're dealing with are secondary or tertiary and just omit consideration of the primary factor.
So is public debt irrelevant, and are policymakers making a huge error right now that's going to lead to some long-term economic consequences?
Well, let's look at, I think public debt is relevant. I don't think the concern that we have about public debt is misspent. It's just we're spending 100% of our time thinking about it and 0% of our time thinking about private debt. Let's take Japan as an illustration. Japan's public debt to GDP in the 1980s was 60%. Pretty low, acceptably low. In the United States right now, we have 100% public debt to GDP. But to counter their crisis and to try to get things going, in the 20-something years since then, their public debt has grown from 60% of GDP to 240% of GDP. So what was a private debt crisis, since they are trying to solve it solely through public debt, has become both a private debt crisis and a public debt crisis. If in '91 they had spent more of their time restructuring private debt, they wouldn't have had to have tried to stimulate through public debt as much as they have.
In other words, the policies that are being adopted in Europe and here in the US focus on austerity could, in the end, make this scenario that you've mapped out worse.
It would. We just create two problems out of one.
Why has private debt increased so much?
Well, it's one of the most amazing things to look at when you really study economic history. And we've taken this back to 1800. And believe me, finding data for the 1800s is not easy. In some cases, we were calling State House and getting state debt directly from old musty archives and State House buildings. I mean, it was not easy. But if you look at the 200-year trend, it has really been an exercise where private debt and public debt, frankly, have both continually grown in excess of GDP. So our conclusion is that private debt growth is necessary to fuel GDP growth. And that's fine as long as private debt is low. It's only when it grows too rapidly or it gets to levels that are too high where it's a problem. So at low levels, private debt is a healthy and necessary part. If you're a business and you want to manufacture more widgets, you borrow to build a new factory. If you're a small business owner and you have one store and you want to build a second store, you borrow to do that. That's a good thing until what's true of an individual and a business is a little debt's great, too much debt is too much. That's also true for a country.
When you look, though, at the growth opportunities in the developed world, isn't it inevitable that private debt will continue to balloon, and isn't it unstoppable?
You know, it is in a certain respect, but it is controllable by one very important tool, which is a banker we know intimately, but economists rarely refer to, and that's the capital requirements of the banks themselves. So right now, capital requirements at banks, simplistically speaking, are about 10%. If you want to make $1 billion in loans, you've got to raise $100 billion in capital to do that. If you want to make another $1 billion in loans, you've got to go raise another $100 billion. And I've had to raise capital a few times in my career, and it's hard. And that is a natural breaking element to private debt growth. In the instances we've seen where there's been runaway private debt growth, it's been because banks learned how to sidestep capital growth limitations through securitizations, through credit default swaps, things like that. I was a banker. I did that too. When I did that, it always felt like a virtuous thing because I was trying to create the best return for shareholders that I could. So if you minimize capital needed, it's better for shareholders. But it creates the opportunity for runaway growth. If you want to change the mix and curtail runaway growth, the way to do it is to increase capital requirements and to close the loopholes that allow institutions to circumvent capital requirements. In my opinion, that is a sufficient mechanism for preventing the kind of crisis that we've seen.
So post-crisis, financial regulation has tried to, or has increased capital requirements. Has it not increased it enough?
Well, it's interesting. We just had Dodd-Frank, and one aspect of that is the increased capital requirements. And I'll get the number wrong, but I think the increased aggregate capital in the system that's required under Dodd-Frank is $68 billion. But remember, during the crisis, we created $2.5 trillion worth of bad loans. $68 billion is a drop in the bucket. So, in my opinion, the debate has been about whether to have 10% or 11% or 12% capital requirements. The debate really needs to be about whether we should have 15 or 20% capital requirements. Frankly, the banking industry is too effective in its lobbying capability for that to really be a consideration. But if you're examining the system and looking for ways to systemically address the problem, that's the answer.
So when you're talking about how to address it, there's regulation, there's consumer behavior, there's the banks, there's credit card industry. How do you address each one? I mean, who needs to take responsibility here, and who can?
You know, unlike a lot of people, you know, in the thousands and tens of thousands of articles that have been written about this crisis, or written about the Great Depression, or written about Japan's crisis, there is always this desire to find a moral scapegoat. You know, consumers shouldn't have gotten those loans. Banks were nefarious in making those loans. And I was kind of in the mix. And even though there's a lot of bad actors in any system, I'm not a person who thinks there was a moral failing. I don't think the banks were nefarious. Some were, but not enough to have created this crisis. I don't think consumers acted avariciously. They was just, you know, this consumer got married and had a kid and wanted to buy a house and happened to be inflated home values when they did it. This consumer moved across the country and had to sell their existing home and buy a new one. That was the majority of the home buying activity. It just happened to be in this runaway lending period. I think the issue is not moral, it's structural. And the structural issue are the capital requirements themselves.
Do consumers need to adjust their behaviors as well? And do Americans need to shift what they define as the American dream? So mortgages aren't the root of all of the debt, but home ownership surely makes up a large part of it. College loans make up a large part of why debt has increased. Is the American dream actually out of reach?
Let's just say we had a magic wand, which we don't have, but if we had a magic wand and could restructure large amounts of debt, I think things would adjust and people would be readily able to re-participate in the mortgage market, and the American dream would be intact in that respect.
Do it over. You're saying do it over.
Do it over with higher capital requirements so that the resulting growth is not as high. But again, I think if you did this kind of thing, it's feasible. But we spent an enormous amount of time as part of this exercise going back to 1945 and looking at the financial wisdom of owning a home. Because it's just an assumption that we should own a home. And we looked at that over that 60, 70-year span to see what the difference would have been if folks had rented and put the down payment in the stock market instead versus owning a home, even with the massive tax advantages that are given to mortgages. And it's more or less a push. And we actually see globally, and this has been reported by Richard Florida and a lot of other folks, that typically in more developed countries you have more rental activities. In more urban areas you have. So the mortgage, it's somewhat of a myth that the mortgage has to be a central element of the American dream. You could do just as well in other things.
And so people need to start thinking that way?
I don't think it hurts them to think that way. And I think folks kind of are. I mean, in a place like New York City, the rental activity versus ownership is relatively high to Des Moines. And I don't think it hurts New York.
Is there an argument here that that what this shows is that wages need to catch up to inflation? That the reason people have to live off of debt so much more is because things cost so much more and they're not making enough to make up that difference?
Clearly, you are absolutely right. Wages do need to catch up to other things, including inflation. But again, without wanting to be repetitive, I would say that one of the things that's suppressing wages is the absence of sufficient demand in our economy. If you had a lot more demand in the economy, you would have a lot more people employed, and employers would have to pay them higher wages to do that. And I think the thing that suppresses demand itself is the high level of debt. So I think the system kind of resets if you restructure debt.
How could you go about restructuring debt? Won't it damage banks? Won't it damage the private sector, companies? In what scenario do you see that working out?
Well, you're exactly right. That is the question, and we have an entire section in the book that covers this. But Paul Volcker actually showed us the way to do this in the Latin American debt crisis. And he did this very quietly. You can read in detail about it today, but at the time, in the age before Facebook and Twitter and everything else, this happened almost without notice. U.S. money center banks had lent far too much to Latin American countries, and there was almost no chance that it was going to repay. If those banks had written those loans down, those banks' capital would have been depleted, and those banks would have either failed or come very close to failure. Volcker got them in a room and said, guys, identify the non-performing section of your Latin American loans and write it off over 10 years. And we as regulators will give you forbearance for that. We won't subtract it and when we do your capital and reserve calculation. So in essence, it let time solve the problem. The government didn't have to bail the banks out. The banks were able to, in effect, recapitalize by putting this bad debt in a deferred suspense account. And a few years later, nobody had noticed and everything was fine. Frankly, I think the exact same structure could be used here. You could take, for example, we talked about these 9 million mortgages. You could take You could take somebody who has a $400,000 loan that's now only worth, for a home that's only worth $300,000, and you could restructure it to $250,000 loan. The bank would write off that $150,000, but instead of having to write it off in 2014, they would write off 1/30th of it in 2014 and use the next 29 years. I recommend 30 years, by the way, instead of 10, because the number's big. And you could let time solve it. The government doesn't have to recapitalize the banks. The banks don't have to dilute existing shareholders. The paradigm Volcker established, believe it or not, everybody won. I think the same tool is available today. It was never mentioned.
So restructuring would be half the solution, and then the capital requirements would be the other half, because otherwise people will just continue the same behavior.
That's right.
So when interest rates go up, as everyone expects that they will in the coming year, do you think that will have an inverse impact on private debt? Will we start to see the chart go down?
It will absolutely have a suppressing effect on private debt. I don't know if it will cause the number to go down, but it will definitely cause the number to stop going up. But what will also happen is, and I can't remember the estimates, but a 300 basis point rise in interest rates would increase the interest bill of U.S. consumers by somewhere between $300 million and $500 billion a year. In a $17 trillion economy, that's huge. So not only will it have a suppressing effect on the growth of private debt, it will have a major impact on GDP itself. And you could actually theorize that the high levels of debt themselves are a suppressant on growth and further growth in that debt. And it's that suppressing effect that's holding interest rates down to begin with. I may be completely wrong in that, but that's a reasonable thing to think about.
So in the solution that you've mapped out, do you think that there's appetite in Washington to pursue that?
Nope, I don't.
Anyone would disagree here?
In fact, when it gets mentioned, frankly, we saw it happen. The real small programs that the Obama administration has put forward, HAMP is one example of that. These are problems that are addressing, if they're successful, they'll address 50,000 mortgages. There's 9 million mortgages that are underwater. So they haven't begun to approach the problem. And whenever they've been trotted out, certain elements of the political spectrum immediately begin denouncing them as, moral hazard, un-American, you name it. And I'm not making that up. That's what has happened in the past. So, I could be optimistic and think that as the message of my book, and frankly other books, I'm not alone in putting this forward. There's a small but growing group of economists that are putting this idea forward. Hopefully it'll gain momentum, and I think as general understanding of this principle's there, then and only then, if you spend a lot of time with politicians, you know that if you present them with the idea, they immediately go to their staff, and their staff checks with economists, and if the idea doesn't resonate there, they ignore it. So we kind of have to get the economic community to sign up to this idea before we get the political community to do it.
So in terms of the coming risk, how close are we to another crisis?
Well, the issue is China, and we're starting to, Cheryl and myself and others are starting to do a lot of detailed work trying to map out exactly how long China can defer its problems. We estimate there's $2 to $3 trillion in bad debt in the Chinese banking system. But China can keep the party going simply by ignoring the bad debt issues in the banks it effectively owns and letting these bad debts roll over so that they're not recognized. And we think, to a large extent, that's what's happening now. How long they can keep this going is the question. We frankly think they can keep it going for a while. I think on the low end it's 2 or 3 years. On the high end, maybe 5 or 6 years. We were just having that debate today. If they keep it going longer than that, the amount of excess capacity that will have occurred globally will be staggering numbers. At some point in time, the thing unravels. So They could act, and here's the irony, for all of these countries, Spain is a great example, we showed the slide. The longer the party keeps going, the tougher the day of reckoning is. And that's, I think, what we're facing in China. We think it'll go on for a few years. We think that's bad news.
An internal risk from the U.S.'s own private debt, is that further down the line?
Yeah, I think our risk in the United States is just that we have lackluster growth going forward, that we have 2 or 3% growth at best. Whereas, if you recall, in the 50s and 60s, our growth was 5 or 6% per annum. You know, and 2 or 3% growth per annum going forward is optimistic, and maybe 1 or 2% growth. So I think we're looking at this not at a crisis risk in the U.S., but we're looking at sideways growth. And one of the things we're looking at relative to the China-Asia situation is where the linkages are. Could a collapse in China, or could slower growth in China, how much will that impact the United States and Africa and Europe and South America? And frankly, I think a disproportionate level of that risk is in and around China itself. So we think South Korea and Japan and Australia and Thailand and Mongolia, believe it or not. You know, we're mapping this on a country-by-country basis, have a lot of risk. The amount of trading that's going on between China and the U.S. and Europe as a percent of the total activity is relatively small, single digits. The amount of lending that has been done by U.S. and European institutions to businesses in China is a small number, relatively speaking. So we think that we will feel it in the form of slower global growth. We don't think it'll precipitate a crisis for us.
Okay. Any questions from the audience? Yes?
Thank you very
Just
much.
hold on for the microphone.
Thank you very much. It's been wonderfully interesting. I have 2 questions. I'll try to be very quick. The first one is the debt crisis is another way of saying capitalism failed in making unwise loans, is it not?
You know, if you look at the history of crisis in the United States from 1800 forward, we had a crisis of this type about every generation. You know, 1819, 1837, 1853, 1873.
What does it say about the profound wisdom of the capitalist system?
Well, I think one of the points we make in the book is it should bring to an end the myth that the invisible hand solves problems.
Thank you. My other question is even shorter. It seems to me that the Chinese can restructure by your method.
I think they could.
And why wouldn't they?
You know, they have a highly vested interest in keeping things going, and we think they probably, in some respects, are already quietly behind the scenes kind of recapitalizing the institution. So yes. So we actually think China has the capacity to preemptively deal with the crisis part of their problem. What they don't have a magic wand for is the fact that their growth overall needs to slow down, has to slow down.
Thank you.
In the back?
Hi. Hello, thank you. This has been very interesting. I just want to bring up a
Can you
concern
stand up?
that... Oh,
I can see you.
I just want to bring up an issue that's of concern to a lot of my peers, but I haven't heard mentioned, and it goes like this. Given the exorbitant amount of debt that has been accrued by a generation of past and current university students, should regulators be doing anything to support a generation of consumers who will be unable to do so at a full capacity?
Yeah, I think you're exactly right. I mean, let me put it in perspective. In the United States right now, there's about $26 trillion in private debt. About $14 trillion of that is corporate debt. About $12 trillion of that is consumer debt. Of the $12 trillion in consumer debt, about $9 trillion, a little less than that, is mortgage debt. Student lending is only $1 trillion of that number. To me, that suggests that the United States has the capacity to supplement the educational system in a way that it's not doing. So I would argue that the fact that it's debt is problematic. And if it were, I mean, after World War II, one of the greatest things that ever happened to our country was the education supported by the GI Bill. Seemed like a pretty good idea still.
I guess a two-part question. You're pretty quick to dismiss inflation as a solution to large debt problems. I'd be interested to hear a little more about why you don't think they could do that, in particular with NGDP targeting. And then also you addressed Dodd-Frank but didn't touch on Basel III, so I'd be interested to hear your thoughts on Basel III capital requirements and liquidity requirements.
Got it. Yeah, so I didn't get into this, but I think that one of the drivers of inflation is loan growth itself, private loan growth itself. And the reason I think that, number one, is we've looked at those correlations in all countries, and you almost never have a situation where inflation doesn't at least somewhat correlate to loan growth. And frankly, high loan growth precede inflation or some delta in inflation. So the idea to me that you could have a generation of inflation without having commensurate private debt growth kind of seems like the null set, because we can't observe it anywhere in history. I mean, even when we theoretically say that inflation can be higher than private loan growth for a generation, it still doesn't put that big a dent in your problem. The problem is we just can't find in history examples where inflation exceeded private debt growth that significantly for that sustained period of time. So anyway, we have more work to do on that one. So but at any rate, Basel III, Basel I, II, and now III, kind of have created a situation where the banks still have a lot of latitude in grading their own homework, so to speak. You know, they get to say this type of loan is only this risky, and therefore our reserve only and capital only needs to be this much. So for that reason alone, it's problematic to me. And as I said, Basel III prescribes about less than $100 billion in additional system capital for the United States. But there's another thing that Basel III, and I lived with this stuff for a long time. There's another thing that Basel III and Basel II and all these others don't really recognize, and that is if you make a good factory loan, and it's a low-risk loan, and you only attribute so much capital to it, but then your competitors finance 10 more industrial plants of exactly the same type, your loan just became a bad loan because you've got overcapacity in that area. Well, one way to think about it is, you know, I've spent a lot of time in South Beach in Miami. You know, at one point in time, somebody built the first high-rise condominium south of 5th Street in there. And it was a spectacular loan, and the investors made a lot of money. But then they built 10 more condominiums right next to it in rapid succession. Even the first loan became bad when all those extra loans were made. And Basel III doesn't really allow folks or cause folks to go back in and say, you assign this level of risk to this category, but you need to reevaluate that risk periodically. So it's like a rear-view mirror look at risk rather than a proactive. But it just gives too much. It doesn't create enough new capital in the systems and gives too much latitude to the system participants.
But the bank's regulators go in, whether for domestic banks or foreign banks, and actually review loans they've made and actually get to tell the banks what type of risk level and what type of capital requirements they get.
Again, it's a rear-view mirror. What they do is they look at history.
No, it's for existing loans they have in the book.
They look at the performance of those loans and the past performance of those loans. But what the system doesn't recognize, and I think what in theory we don't recognize, is the category that's good today can become bad if we lend too much into that category.
But that's why you've got ongoing portfolio maintenance.
It's all.
It's the risk, and banks then.
Let me tell you, it was in place in '07, and it missed by $2.5 trillion. It's a rear view mirror. No stress exercise I ever participated in, people go in and do a stress scenario and they put 10% stress on the system. Well, no actual crisis had anywhere near that little stress. So people just, in advance of a crisis, never contemplate the magnitude of the crisis. And I think that's the issue.
Any other questions?
Thanks. I've got two questions. The first one is one of clarification. You talked and showed a lot of data about the cyclical effect of different crises across the generations. You showed the growth in private debt. I'd like clarification what happened post the debt crisis and those other situations. And I got a sense of, from the data you showed, that this crisis is different because private debt hasn't decreased significantly. So that's number one. The second one is just more philosophical. Really what we're facing is boom and bust, and it's a repeat of essentially a natural economic and human phenomenon. Is it a bad thing? And if governments and economists embraced your philosophy, wouldn't the natural human sort of psyche find another method or phenomenon to create a boom-bust cycle in some other way, regardless of private debt?
Yeah, let me take your second question first and then ask you to repeat your first one. Yeah, it's boom and bust, but it would be fine if it was boom and bust that had the same high and low points. It's been boom and bust at a steep ascent. So every new boom is at a higher level than the height of the previous boom.
Isn't that the nature of economic growth?
Well, I think it's exactly the nature of economic growth, but I think it's been an unrecognized component of it. You don't have any dialogue except by a very small minority of economists that look at this phenomenon of a tripling of private debt to GDP levels. So what you have instead is a debate about government debt and almost no discussion of this. Now, do you mind repeating your first question? Oh, what happened after the crisis?
Yeah, there was growth in private debt. If you look at those from the crisis and the Great Depression and the other ones you cited, did you see a drop-off in private debt, significant drop-off, to return to a boom period? And if we haven't seen that, why has that broken the cycle this time around?
Well, it is a very important question, and the book goes into this in some detail. But in the Great Depression, and in the depressions that preceded the Great Depression, 1873 and 1893 and so forth, there was a material deleveraging. Nominally, from 1930 to 1933, bank loans declined by 25%. It's unthinkable in today's world. Nominally, bank loans declined 2% after the 2008 crisis. That's the difference between 25% and 2%. But the decline of 25% in the Great Depression led dollar to dollar to the 45% decline in GDP itself, nominally. It was the issue. That's why we had such a profound adverse circumstance in the 1930s. The fact that we let things deleverage so rapidly was the cause of the problem. And the Fed figured that out. Bernanke and others who studied this figured that out, that you had to use liquidity and capital to prevent deleveraging. So this time around, we didn't have that calamity because we effectively prevented the deleveraging. We had a little bit of deleveraging, but not a lot. So yeah, we didn't have the Great Depression. But guess what? We still have high levels of debt. Coming out of World War II, private debt to GDP had gone from 150% down to 50%. That's how much deleveraging occurred over that 10 to 15-year span. We haven't had that. So we avoided, it's a paradox. We avoided the Great Depression. We're still lugging around a large load of private debt.
Avoided or
delayed? Would it have been better to deleverage?
Well, it would not have been better to deleverage because every dollar you spend to net pay down aggregate private debt is a dollar you take out of GDP. So if we had spent the money to pay down that $2.5 trillion, we would have contracted GDP by $2.5 trillion on a then $15 trillion economy. It would have been calamitous. unless you did it through restructuring. Restructuring is the one way you can fix that number without contracting GDP. And that's why, even though it's a lightning rod and a controversial thing to recommend, it's the only one that still works. It's the least bad choice.
But in that comparison, aren't you ignoring the massive fiscal spending of World War II?
Well, I'm talking about the period way before World War II.
Sure, but you go up to 1939, and it's arguably a relatively anemic, I'm not an expert on this stuff, but it's a relatively anemic economic growth. You have the second mini depression of 1937, and then it's...
You're exactly right.
Yeah.
Starting in 39-40, there's a government spending shoots up, and government debt to GDP reaches, I think, almost 150%. And in fact, it almost displaces private borrowing, because the funding of the GM and Ford plants to build tanks, instead of being debt of those corporations, is federal government debt. So in a certain sense, it's not only a big number, but it displaces private lending. And by the way, I contrast that to World War I, where we did almost the same thing, but the private sector did the borrowing. So private sector debt gets to unprecedented highs. So we flip-flop by World War II. But at the end of World War II, when we start the great deleveraging of public debt, the thing that makes it possible is rapid ascent of private debt. So private debt leveraging from 1945 to 1980, actually, because the thing happens that trade-off doesn't end till 1980. Private debt grows more than public debt shrinks as a percent of GDP, and in fact is what enables us to deleverage from public debt.
Sure, right here.
Thank you for coming here today. I have two questions for you. The first is about China. So China's government thinks that a major reason of the slowdown of GDP is the economic structure transformation, which refers to decrease the percentage of investment and increase the percentage of consumption.
The rebalancing.
Yeah, but based on my own personal experience, I think that a lot of Chinese people use more and more private debt to consume. So will the control of the private debt have an adverse impact on the economic structure transformation?
First of all, will you join our study team as we get into this kind of... Secondly, I think you're exactly right. You know, if you're rebalancing and you're asking the consumers to take a bigger share of the economy, one of the ways they do that is through debt, which exacerbates. Right now, as the slide showed, private debt to GDP has grown 60% in 5 years and is now almost 210%. So yeah, absolutely. It's the smaller part of it, but it's part of it.
Okay, but you think this is more important than the economic structure transformation?
Yeah, I think if you're looking to, I think that rebalancing needs to occur. I think it's a harder challenge. We were just spending time talking about this today. I think it's a harder, just to say let's rebalance is easy to say and extraordinarily difficult to do. I think it has some impact. But the real thing that has impact in China right now is the fact they've got way too many unsold homes. They've got way too much steel that hadn't been sold. There's, everywhere you look in that economy, there's overcapacity. That's the issue.
And my second question is about the data analysis. So you mentioned that a private debt is an important predictor, is the best predictor of the economic crisis. So I want to know which approach do you use during your research? Is it you put all the indicators in the economic model and analysis it, or do you have some hold-on samples? That is to say, you pretend you don't have the last period of the data, and you use the existing data to predict the results and to see which has the closest result to the real data.
Our analysis was very simple. We looked at actual crisis, of which there's 22 by the Levin definition of financial crisis in these major economies in the post-World War II period. and we looked at what was true in the 5 years leading up to that crisis. And we looked at private debt growth, GDP, current, it's 20 different factors. And when you did that, the results were overwhelming. It's almost always true that you have the private debt growth, almost never true that you have a predominance of any other characteristic. That was our analysis.
So you only examine the correlation between these factors?
That's right.
Okay, thanks.
How many, do we have time for a few more questions? Okay. So in the back, and then, did you ask a question?
I haven't yet.
Oh, okay, and then over here.
How do you see, thank you for your work, it's fabulous. How do you see addressing the relationship between credit and asset prices, financial asset prices? And there's some, like Steve Keen and others have talked about this, spent a lifetime talking about this, and others as well, that credit expansion acts as an asset price accelerator. And that feeds on itself. You know, you want to buy a house because prices are going up, so you leverage to buy a house, which in turn makes houses less affordable. And ironically, many affordable housing NGOs, you know, don't really have a solution how to get out of that. Their solution is easier credit and, interestingly, lower capital requirements. They act as kind of human shields for the financial industry. So instead of, how do you have some type of systemic reform so you don't get into this almost inevitable situation where you need a debt jubilee to get out or face years of stagnation or a liquidity / solvency crisis?
We know Steve Keen, and we like his work a lot, and we think his work is spot on. There's another couple of academicians, Mian and Sufi, who just published a book called House of Debt, who did a really wonderful job of parsing through this very idea. But what you're getting at is the under-recognized fact that lending policy itself, absent organic demand, can cause asset price values to go up. This is easy to think about relative to homes. If you're selling homes and every lender changes their policy from 75% LTV to 100% LTV, the number of eligible buyers increases, therefore demand for the houses increases and the prices go up. So a simple change in lending policy, absent any other thing, ceteris paribus, causes housing prices to go up. But market participants don't recognize that, and they think it's some enduring function or some enduring trend. And so they jump on the bandwagon, exacerbating the problem, and inevitably it busts, asset values collapse, and you have loans that are now underwater. It's easy to understand. But that's true in every asset category. Businesses, I'm in venture capital, and I do a lot of work with bank financing of acquisitions of small businesses. Banks, let's say, lend to individuals to buy businesses at 3 times EBITDA. Well, guess what? If all banks lend at 3 times EBITDA, the valuations of small businesses is about 3 times EBITDA. And if the bank policies, just because they're trying to outdo the bank across the street, or because they want more loans, or because they're just feeling confident, change their policy to 4 times EBITDA, the valuations of businesses goes to 4 times EBITDA. So it's a self-fulfilling prophecy, and it is intrinsic to the problem. And I hate to be a broken record, but I think capital requirements properly applied prevents that.
Last question.
Thanks so much for your talk. I thought it was very interesting, and it was interesting to hear your point about a good loan becoming bad because of more creation of overcapacity in a given area. And my question is, one thing that hasn't been talked about at all tonight is environmental crisis, climate crisis, which is pretty well recognized to be surrounding us and of increasing severity. And I think the examples you gave of the creation of overcapacity is an interesting example of bank lending not being oriented in terms of creating a short-term profit or a long-term profit even, but not being oriented towards creating wealth that's going to sustain human life. Do you have is there any ways that you can see that bank lending and the creation of our future infrastructure that we're going to have to live with, hopefully, if we survive for the next, centuries, that can be tied towards something that's going to allow us to weather this increasing storm, or is more government action required? Thanks so much.
Well, thank you for that question. I mean, I'm not an expert in that area, and there's clearly a lot more important things that need to be done to address that issue than lending policy. But I think you're right in thinking that lending policy can exacerbate the issue. Just take the issue of coal. You know, I think right now China's buying 50% of the world's coal. It's something really high like that. Well, that's clearly a function of their lending book. And more moderate lending practices alone would reduce the consumption of coal. So I don't think it's central to the issue you bring up, but it's in there somewhere.
Any last words before we... What do you want everyone to remember as they leave today?
I just want to say thank you. I'm really grateful that everybody came, and I'm grateful to you, Reva, and Cheryl, and Tyler, and for y'all to give up a little time this evening is something I greatly appreciate.
Thank you, and thanks everyone. Richard will be signing books in the back, so pick up a copy, and thanks everyone for coming.
Thank you very, very much.
Thank you.
Questions were fabulous.
That was great. Thank you.